On the 16th of September, 1992, one man made a single trade and walked away with $1 billion in profit. The country on the losing side? Great Britain. This is the Prince's Ledger, where money, power, and history collide. And nothing is ever as simple as it looks. To understand what happened, you need to understand the trap Britain had built for itself. In 1990, Britain joined the European exchange rate mechanism, locking the pound at 2.95 Deutsche Marks. It looked like confidence. It was actually a cage. Britain had entered at too high a value. Its economy was slowing, unemployment was rising, and the interest rates needed to defend the pound were strangling ordinary British homeowners. The rate was wrong, and every serious player in global finance could see it. Every player except, apparently, the British government. George Soros had been watching. A Hungarian-born survivor of Nazi occupation, who had built one of the world's most powerful hedge funds from nothing. By 1992, his quantum fund controlled over $10 billion. Soros believed in a simple idea. If enough people believe a currency will fall, it will fall. Belief becomes reality, and Soros believed the pound would fall. Not out of malice, not out of ideology. Simply because the mathematics were undeniable. Britain was holding a beach ball underwater, and hoping no one would notice. Soros noticed. Through the summer of 1992, Soros quietly borrowed billions of pounds and immediately converted them into Deutsche Marks. The logic was clean. If the pound fell, he could buy the pounds back cheaply, repay the loan, and pocket the difference. By September, he had committed over $10 billion to the trade. Word spread. Other funds positioned themselves the same way. The market smelled blood. The British government, meanwhile, spent billions in reserves buying pounds to hold the rate. They raised interest rates to 12%. Then, in a single panicked afternoon, announced 15%. Every British homeowner with a mortgage felt it immediately. But the reserves were running out, and the market knew it. By evening on September 16th, it was over. Chancellor Norman Lamont stepped in front of cameras and announced Britain was leaving the exchange rate mechanism. The pound would float freely. In a single day, Britain had spent an estimated £3 billion defending a rate it could not hold. The pound dropped 17% almost immediately. Soros made approximately $1 billion in profit. He became known forever as the man who broke the Bank of England. But here is what most people miss. Soros didn't create the problem. He found it. Britain's mistake was entering the system at the wrong rate, and then defending that rate with its citizens' economic well-being as collateral. The overvaluation was real. The government was the one holding the beach ball underwater and hoping nobody noticed. In a world where capital moves freely and traders operate with billions, a government's ability to defend an unsustainable position is always finite. Markets have longer memories and deeper pockets than governments want to admit. The pound wasn't broken by Soros. The pound was already broken. He simply collected the bill. And here's the part that should stay with you. After Black Wednesday, freed from the wrong exchange rate, the British economy recovered. Interest rates fell. Exports boomed. The 1990s became one of Britain's strongest decades of growth. What looked like a national humiliation quietly became the best thing that could have happened. Governments make promises. They fix rates, peg currencies, and tell their citizens the system is permanent. But promises are only as strong as the reality they rest on. When the reality doesn't match the promise, someone will always find the gap. The question worth asking isn't why Soros did what he did. The question is, why governments keep making promises they cannot keep and expecting the market not to notice. History has the answers. The Prince's Ledger will show you where to look.